Another payrolls beat. Live from New York City this morning. Good morning, good morning. Your equity market positive 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York coming up. The latest payrolls report coming in hot. Bruised regional banks looking to get to the weekend, and the iPhone bouncing back, helping Apple top estimates. We begin with the big issue, payrolls in America.
The jobs report, payrolls.
The actual payrolls number.
This is not a quitting labor market.
The unemployment rate is still at a multi-decade low.
And wages are the key here. Wages are still too high.
Some tantalizing evidence of wage growth coming off the boil.
A little bit of deceleration in payroll wages.
That just wasn't corroborated with what we saw in the employment cost index.
If you have this wage pressure,
they're not consistent with a 2% inflation target.
Those higher wages get passed into higher prices, and you still have an issue with inflation.
We've been expecting a slowdown for really the past 6 months.
As the chairman noted,
you've still got a decent strength in the labor market.
So far, the data are not telling us that.
The labor market in the U.S. is still very tight.
Mike McKee on the story down in D.C. Mike, not bad, not bad.
Yeah, oops, we did it again. 13 months in a row where the jobs number comes in higher than the forecast from the economists that we surveyed, 253,000 in the month of April. Now, the nuance here, or the slightly bad news, is we saw big revisions down of over 70,000 in each month in March and February, so a total of 149,000 fewer jobs in those months. But look at the unemployment rate, 3.4%. That is a multi-decade low, back to it, partly because the labor force shrank, but a lot fewer people were unemployed than employed. Participation rate doesn't change, and we saw a tick up in the prime age participation rate, which is something that the Fed wanted to see. And average hourly earnings, you can play it round or flat, 0.5 for the month, 4.4% on a year-over-year basis. Some say that is inflationary. Some say that's not. Taking a look at where the jobs are and aren't, professional services gained 43,000, but temporary services lost 23,000. So not clear if that's a signal or not. Leisure and hospitality, 31,000. They had been gaining 78,000 a month on average over the last 6 months. So basically this shows a slowdown. Although manufacturing and construction were expected to drop, they did not. And one more quick look, John, at the average hourly earnings situation. Is it inflationary? Is it not? Lisa was thinking it might be. You take a look at the range in which people at the Fed think you can sustain 2% inflation, and we're still well above that. So whatever you think of average hourly earnings as an indicator, it does suggest there are still some inflationary pressures out there.
Mike, thank you. We'll try and touch base with you again later this hour. The jobs market, again, looking resilient. Joining us now to discuss, I'm pleased to say, Mohammed Al-Erin of Queen's College, Cambridge, alongside BlackRock's Rick Reeder. Mohammed, first of all to you, this labour market looks pretty resilient, doesn't it?
Oh, it is amazing. And just think of the following three things. On the one hand, we beat across the board: job creation, wage growth, labor participation force, and also the unemployment rate. That's the good news. Now, even when you adjust for the revisions, as Mike said, 149,000, we still beat across the board on the other three things. So it is good news for an economy that's trying to avoid a recession, but it makes the Fed's trilemma even harder.
Rick, is this good news?
So, so first of all, the stories that we're going into recession, deep recession, well, I'm not sure I buy into that. I mean, think about where consumption is, where income is, where employment is. It's ambiguous to me as to whether we're going to go into recession. But I would say one thing, though, we are slowing. And I think if you actually parse these numbers a bit, and you look at the goods employment, and look at the 3-month moving average, 6-month moving average, 12-month, you're clearly slowing. The cyclical nature of this report, the goods employment is clearly slowing. Temporary hiring, as Mike said, that's clearly slowing. That's an indicator of what the forward's going to look like. And the last one, you look at leisure and hospitality, that's coming down. That's a cyclical one. Where's the big nut of where the jobs are? Healthcare and education. Those are not cyclical. Teachers, nurses, et cetera, they're not interest rate sensitive. They're not cyclical. if you're the Fed and you're parsing this data and you say, okay, what's happening to the cyclical influences? And by the way, we saw this in all the earnings reports. You know, the industrial is slowing, retailing is slowing. The cyclical is slowing down. And I think the T+1, when you analyze this report, will suggest cyclical momentum down. And that, to me, is a real takeaway from a number that, without question, is solid. And the backdrop is solid, which questions the deep recession story for sure.
So let's fold in the banking story as well. Mohammed, you touched on this. You alluded to it. How much of a conflict is there right now between monetary policy objectives and financial stability?
So pick up on what Rick correctly said. What we're seeing is that the service sector more generally is the engine of growth right now. And that's important because, like him, I've argued for a long time, we don't necessarily have a recession in our future. We can avoid it. But it makes the job of the Fed more difficult because that's the sector that, as Rick correctly said, is less sensitive to interest rates. So the Fed has one of two choices, either to go after that source of inflation as it sees it through higher interest rates and therefore risk financial stability, and we've already got fragility in the financial system, or try to somehow tolerate higher inflation because it is concerned about that third leg of the trilemma. John, the problem all of us have is this Fed is very hard to predict. So I have no idea what they're going to go for because there haven't been that's consistent over time.
These bank stocks have been very hard to predict. Let's pick out two of them. PacWest, Western Alliance. PacWest right now in the pre-market up by 34% or so. Western Alliance trying to bounce back as well, up by more than 30%. Rick, two questions for you. Can the US economy live with 5% rates? One. Two, can the US banking system live with 5% rates? And is the answer to both those questions the same or different?
It's different. So U.S. economy is incredibly resilient. And the shift to the U.S. economy, like Mohammed said, we've moved to a more service-oriented economy. By the way, service-oriented economy is much less interest-sensitive, and you can see this when you break down this jobs report. Much less interest-sensitive. By the way, you look at CapEx in this country. It goes to information processing. It goes to AI. It doesn't go through to hard asset like it used to, which is interest rate sensitive. I think the thing that is really important, and I think for the Fed is really important, we've moved to a very restrictive level. Financial transmission is being tangibly impacted. Capital, you think about how the financial system works. You have asset and liabilities, and what's left over is capital. When you hurt the assets, when you bludgeon the assets and the cost of your liabilities go up, you really damage capital. So financial transmission will slow significantly. Credit contraction will follow. Listen, I think the U.S. economy is going to slow. I just don't think when you have a different economy than we've had in the past, I'm just not sure we're going to a deep recession for sure. Could you have a small recession? Maybe. But I think we got to be really careful. I think the Fed's got to be really careful because you don't want to damage residential real estate. There's a slowdown in activity. That's where a lot of the equity in the country is. And you got to be really careful about not going too far to damage that. We've certainly impacted commercial real estate, but residential is 4 to 5 times bigger, and it's where you hit the core of the economy versus commercial real estate, where the equity is held in commercial real estate is different than when the core of the economy is in residential.
To that point, Rick, is that what started to happen this week? Away from residential, you brought up commercial real estate. Has this crisis, which Mohammed doesn't like to call it, and we'll come back to that in a moment, in the regionals morphed away from a rate shock to fears around a credit shock further down the road, perhaps even around the corner?
So, John, I think it would be naive to say that we're not going to see a tangible credit contraction. You think about where the epicenter of this lies. I mean, it's commercial real estate, but it's also the asset liability mismatch. It's a duration mismatch in regional small banks. You know, given the Fed stayed on hold for a long time, kept rates at zero, then you shock the rate higher, you bludgeon the capital of those entities. So think about the financing to small business, to local commercial real estate. That is going to have a real impact. That is real credit contraction that's going to take place. You know, big companies today have turned their debt out. They can get plenty of funding. You're going to create what's going to happen from here is a dynamic that you will have real credit contraction, particularly in those areas that are affected by the small and regional banks. But also, I mean, by the way, the banking system is only 15 to 20% of liabilities in the country. There's a bigger financial dynamic that has to be considered. So, you know, my opinion is the Fed, you know, they have to look at all these things, but you know, clearly they got to be careful about this credit contraction that's coming.
Mohammed, what's your opinion?
So I think Rick is right in terms of we're going to get less credit extended to the economy. The question is is how much less. Look, we are in phase 2 right now. It is different from phase 1. Phase 1 was a mishandled interest rate cycle, doing nothing and doing a lot very quickly, and poor supervision and regulation, exposing poor management. That was what those first 4 banks was about. Now we're in phase 2, where contagion, and in particular, people reacting to how the previous failures were handled, including First Republic, where you destroyed 97% of the value in the stock price during the process, people now have become very edgy. So now we have stage 2, where banks that are not particularly badly managed, they have issues, but they're not particularly badly managed, are suddenly vulnerable. And they're vulnerable to this path dependency, this multiple equilibria. As you go down, and phase 3 would be widespread financial contagion. Hopefully we won't get there. But as you go down that spectrum, the risk of credit contraction goes up significantly. So it's very important to now do a much better containing this problem than we did in phase 1, which only contributed to phase 2 because of the way it was handled.
We'll return to this problem in a moment and talk about how to contain it. PacWest, a better day. That stock has had an awful week. We're positive there by more than 30%. Western Alliance up more than 25% right now, fading just a little bit, 20 minutes out from the opening bell. Rick and Mohammed are going to stick with us. Let's get you some movers. We can do that with Abby. Morning, Abby.
Good morning, John. And let's start out with the big one on the day, and that goes beyond the banks. Apple. We do have the shares popping, defying the naysayers who thought that Apple was going to be falling given the fact that earnings and revenue declining on a year-over-year basis. Now, that is happening, but we do have actually here we're looking at Lyft and Carvana, and you can see the dramatic difference between Lyft and Carvana. Lyft tumbling as the sales guide for the current quarter was lowered, having to do with the per rider economics diminishing. Carvana, on the other hand, really this troubled car sales company having a big lift here and a big quarter, up 41%, John.
Abby, thank you. Coming up, the economy showing resilience, regional banks looking shaky.
Another rate hike is really bad news for a lot of these banks. Regional banks suffered significantly in trading after that announcement. So, you know, I think this banking crisis has got more legs to it.
After 6 days of losses, PacWest are leading the rebound in the regionals. That conversation up next.
The situation we have right now is we have effectively unlimited deposit insurance. Only the difference is that the billionaires who are taking advantage of it and the billionaire banks that are taking advantage of it are not paying for it.
I'm not sure that last bit is true, but we'll let it go. The FDIC's deposit insurance fund needs a refill, and the big banks are set to foot the bill. Bloomberg reporting the US is, quote, poised to exempt smaller lenders from kicking in extra money and instead saddle the biggest banks with much of the check. This is the most battered regional banks rebound in the pre-market. PacWest leading those names higher after an ugly week of losses. Kelly Lyons, you spoke to Senator Warren. What's next?
Well, it's a good question. At the very least, and I don't want to jinx anything, it looks like potentially it may not be another working weekend for the FDIC in the world of financial regulation, as we do see the rebound in some of these names we were worried about. PacWest right now up 35%. Granted, that only goes so far to unwind the losses of the week. But as for the reason why we may be rebounding, perhaps panic is giving way to a harder look at the fundamentals, considering PacWest earlier this week said insured deposits represent now about 75% of the total. They've actually seen deposits picking up. There is also the consideration that the Fed released the latest data on its lending facilities yesterday, and demand for that dropped would suggest that some of those liquidity challenges are beginning to fade. Then there is also this idea that the FDIC may be letting the smaller guys off the hook in refilling that deposit insurance fund, which of course took billions of dollars in losses with the resolution of SVB and Signature Bank. So any institution with less than $10 billion in assets, we understand, won't have to pay those special assessment fees. That would apply to about 4,000 institutions, and even banks with less than $50 billion may also avoid those fees. It does raise the question, though, John, of whether we will see broader reform to deposit insurance. The FDIC released some proposals earlier this week, some of which include unlimited coverage or perhaps targeted coverage, which would raise the insured cap for businesses specifically. There is a massive question, though, as to whether or not Congress would get behind that. Yes, Senator Elizabeth Warren would like to see that insurance cap raised, but even some of her fellow Democrats, like Senator Cortez Masto, expressed to me yesterday concern about the moral hazard. And Republicans I've spoken with don't like that idea very much, John.
Katie, great coverage, as always. Thank you. Back with us for a final word, Mohammed Al-Erin, Rick Reeder alongside him. Mohammed, first to you, you talked about containment. Mohammed, what is the circuit breaker right now for the stress we're witnessing over the last 6 weeks?
One is for banks to continue to be more proactive. What's different this time around is when there's been uncertainty about banks, the institutions haven't allowed the adverse dynamics to build up momentum. They've come out. The second thing we need is quicker resolution, much better private-public discussions, because it's in everybody's interest to get to resolution quickly if needed. We can't drag it out like we did with First Republic. Somehow, and I really feel for Rick and my former colleagues at PIMCO, stabilize the front end of the curve. I don't know how they are navigating this incredible volatility. And then for later on, John, reforming deposit insurance. This is all doable, by the way. We just need to get it done.
Navigating the turmoil, the volatility, Rick, Mohammed has some sympathy for you. The 2 years had a lower 365 and a higher 416. It's another big range again this week, Rick. How are you navigating that?
Well, I look forward to Saturday mornings. I mean, listen, I think the way to do it is the markets are incredibly jumpy. They're incredibly illiquid. You get debt ceiling. I mean, the only way I found it's been fruitful to do it is just fade the extremes. I mean, the extremes you're seeing are intense. And I think the only way to do it is just go the other way when you get these extremes. Listen, we were on a call. We did the show last week, I think, Jonathan. We talked about, we're going to deep recession. I don't think that's right. I think the Fed's still got to keep rates here for a bit of time. Listen, the only way the banking system really improves in terms of regional small banks, et cetera, is at some point rates have to come down because you got to increase the price of their assets and you got to reduce the cost of their liabilities. That's got to happen. My sense is that's not going to be the next few months. So, you hide out. We talked about in your show commercial paper, really front end stuff that you get. I mean, you get 6% now. Like how often in your career could you just sit back and clip 6 without taking a lot of other commercial paper? Big companies that aren't threatening default in the next month or two. So there's a lot of things to do in the markets. Emerging markets, get outside the U.S. There's some things to do because the dollar's not going to appreciate like it did last year. There's some things to do it, but you got to be tactical as to when the markets seem to have these spikes of fear.
So, Rick, can you give me an example of that in the past week or so, when you've seen these big moves, where the Treasury market has been kicked around by what's happening in a couple of names, PacWest, Western Alliance? What are the kind of things you have done over the last few days?
So, Jonathan, I'll tell you, when you do things, you look really silly early. I mean, so, for example, the front end, the 2-year note, et cetera, it rallies, you sell some, it rallies again. And because you're getting these extremes and these fear moves, the first sale you make, you feel like a dope for having made it, and then you do it again. And then, and then ultimately, like today, it reverses itself. So it's trying to take advantage of that and have some fortitude around you're making the right decision around these extremes. But quite frankly, you try and do it in smaller size because, the trends tend to move until you get news to the contrary. So, trying to be active around it and try and find opportunity. By the way, not just in rates. Think about the asset sales, mortgages, and other areas to try and be tactical. And when you see some of those extremes, when you hear rumors, there's some sales coming out, that's when you want to try and take advantage and buy some things. But it's very much like a counter trade, what is a jumpy, illiquid market.
It's been crazy, particularly the front end. Mohammed, you've covered that so well over the last few months. It's been the banking stocks this week that has kicked it around. I've heard from a lot of analysts quotes like this. This came from Cowen. We believe the banks are having their GameStop-like moment where social media is amplifying non-traditional approaches to assessing solvency. Truist said this: the recent sell-off in regional bank stocks is overdone as price action has been disconnected from fundamentals. Mohammed, that last line there, that the price action is divorced from the fundamentals, aren't the fundamentals now shaped by the price action in the banking sector?
Oh, absolutely. It goes back to what will happen to credit extension. This is a really hard time. There's so many things moving. I feel for Rick having to get to Saturday, all of us are going to have to get to the end of the year where the Fed is telling us rates are going to be up here and the market is telling no, it's going to be down here. And the difference is 75 to 100 basis points. That difference has to be resolved before we all get to sleep well. So, we are not yet out of the woods because there is so much discrepancy in pricing, and we no longer have anchors. Forward policy is not an anchor. The economy is not sufficiently an anchor, and the banking system is not sufficiently an anchor. So this is a financial system that lacks anchors right now.
Mohammed, a number of Fridays ago, you said this wasn't a crisis. You pushed back a little bit around the term credit crunch. You said it's a bit more nuanced than that. On those 2 points, Mohammed, any shift in your opinion at all over the last week?
Yeah, I must say I'm more worried because I didn't expect that we're going to mishandle First Republic as much as we did, and therefore make the market so much more jittery, and therefore get these incredible moves on very little. I hope we can contain it to what I call the second phase. If we get to the third phase, which I hope we can avoid, then I'm going to go back and say, I'm sorry, this is a crisis. I don't think it's a crisis now. The big banks aren't involved. The banking system as a whole is not involved. But the cancer within that is starting to spread, and you've got to keep an eye on that. It can be contained, but it hasn't been contained as yet.
Well, the scariest words right now, I think, for any bank stock, Rick, are these words, strategic options. But to Mohammed's point, because we know the template now, that when you hear the word strategic options over the last few months, that's ultimately meant that bank is going to hit the wall because no one's stepping in until it does. Rick, how do we prevent that from happening?
I mean, it's tricky. I mean, all of this is really tricky. I mean, listen, I think we got to work through some of this process. And like I said, it's not, the deposit outflow is obviously that. And I think the Fed Treasury has done a great job of stabilizing that. The problem is the asset liability mismatch. And I think we're going to have to keep working through some of these situations. And it's not easily fixed until the rate paradigm changes because of the nature of those embedded, because of what's embedded on balance sheet. So we're going to have a tricky period where capital has come down, and you got to work through that. But like we said, this payroll number today, you've got an incredibly resilient, durable economy. As long as you don't get exogenous shock from whether it's debt ceiling, whether it's the financial transmission process, whether it's geopolitical. Economy is pretty darn strong, and it has an incredible ability to withstand some of these influences.
Rick, is it even about deposits anymore? PacWest, they say this about their deposits. They say that insured deposits total 75%. Western Alliance say that number is at 74%. Over at SVB, uninsured deposits was more than 90%. It's such a different profile for the deposit base, yet here we are. Rick, is this even about deposits anymore?
I mean, I found it unbelievable, John. I mean, it was markets can only do one thing at a time. It's pretty unbelievable to me. There's a laser focus on one thing. And you remember, it was just how much, and like we got to know the number, how many deposits came out. I don't think it is, because the funding, the Fed's done a great job of providing liquidity and backstop financing. So I don't really think it's a funding. It's the cost of the funding that is the salient issue. And I think, markets are becoming much more attuned to that. Like I say, the deposits, as long as you have durable funding through the Federal Reserve and through other sources, then it really just becomes, what's your asset liability mismatch? How much capital do you have to raise? How many assets will you have to sell to try and manage your liquidity in the system? But no, I don't. But to manage, liquidity / capital, that's where I think the focus needs to be.
Mohammed, I want to give you the final word, because you've said this a few times over the last few months. When the three of us have been talking about the labour market and inflation and this Fed, you've said that ultimately perhaps this Fed will have to accept or tolerate a higher inflation rate. Mohammed, given what's materialised over the last couple of months, what continues to evolve, do all roads still lead to that destination for you? Because this Fed was so late that ultimately they're just going to have to accept or tolerate higher inflation?
Yes, in the sense, John, we are deep in the world of second best. There is no optimal policy response. We lost that because the Fed didn't react quickly enough. So in this world of second best, among bad choices, this is the better. The alternative of just going for 2%, regardless of what you do to growth, regardless of what you do to the financial system, is not a good one. And the other alternative of actually moving your inflation target explicitly at a time where you've lost credibility is also not a good one. So you've got to somehow continue to convince people that you're aiming for a good destination and just manage the journey a lot more responsibly.
Mohammed, looking forward to your commentary over the next few months alongside Rick Reader. To two of you, thank you for joining this programme. Two of the very best on this market and on policy. Coming up shortly, Dan Ives of Apple. Anastasia Amoroso, iCapital, Mike Collins, PGIM. Your opening bell is up next. Live from New York City, about 22 seconds away from the opening bell this morning. Good morning to you. Payrolls report looking pretty decent, solid, resilient, pick your word. Equity futures right now positive 0.9% on the S&P 500. On the Nasdaq, positive 0.7. Through Thursday, down on the week. Down for 4 straight days on the S&P 500. Let's see if we can snap that this morning. There's the opening bell. Switch at the board and get to the bond market. Yields look a little something like this on a 10-year, higher by 6 basis points, 3.44 on a 10-year. Dollar showing a touch of strength against the euro, a little weaker. A break of 110 to the downside, 109.86. We're negative there by 0.2%. And crude back through 70, up to 3.7% higher right now, to $71 and about 10 cents. 20 seconds into the session, we look a little something like this. We are positive 0.9% on the S&P, on the Nasdaq, up by 0.9% also. One stock supporting the price action, Apple, snapping a 4-day losing streak after reporting better than expected revenue on robust iPhone sales. Ed Ludlow covering the story on the West Coast for us. Morning, Ed.
Yeah, good morning, Jonathan. Up 3%. So services actually missed expectations, but it was one of just 2 categories that actually grew year on year. About a 5.5% gain relative to the same period a year ago. The other outperformer that beat expectations was iPhone sales. Just 1.5% sales growth year on year, but it shows that Apple's weathering the kind of tough environment for smartphone demand globally. Real strength in emerging markets. Tim Cook talked a lot about India and emerging markets broadly. In terms of the limited guidance that we got, it's really interesting to note the impact of FX here as a headwind. About 500 basis points in the quarter gone, but note the forward-looking statement that going into the current period, while there will be an FX headwind to the top line, we actually expect FX to be flat as an impact to the bottom line. And that's the first time for Apple that's happened in a lot of quarters. They're really talking about India. They see a growing middle class, and Tim Cook's hope is that more of that growing middle class in India will buy iPhones. That's literally how he put it. A lot of emphasis on the financial services side of the business being a driver of performance as well. And then the buzzword AI. He was asked about AI by one of the analysts. It was much more muted than we saw from his mega cap tech peers like Meta or Microsoft or Alphabet. But he did say that AI is huge in Apple's eyes. They will be thoughtful about how they integrate it more deeply alongside machine learning into the product base. And again, it was a record quarter for a number of categories, but the important bit is that another record quarter globally for the installed base of products across the entire lineup. So it seems like this was robust print, John.
Looks like it. Looking at the stock move. Ed, thanks for that. Great coverage yesterday evening as well. Apple up by 3.4%. Dan Ives of Wedbush coming up in about 6 minutes' time. Looking forward to that conversation. More from the south side. Jefferies resuming their buy rating on Apple after earnings. They said this: few things in the market are as certain as Apple's cash-generating abilities, product resilience, and remarkably high consumer sentiment. The March quarter had all 3 on display. That stock, 171 in early trading. Let's get to the banks, the regionals, from big tech to some struggling names. PacWest rebounding after plunging almost 70% this week. Its peers following suit heading into the weekend. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, in some ways, the move that we're seeing this morning defies fundamentals. The exact catalyst here may be unclear, but we did get some good news out of some of these names, PacWest in particular. While it did confirm that it's in talks with several investors, it also said this week that deposits have actually risen since March. And Western Alliance, too, said that it hasn't seen any unusual deposit flows since, of course, First Republic collapse, which, granted, was just a couple of days ago. And Bloomberg News also reporting this week that the FDIC will exempt some of these smaller banks from having to kick in extra money to that deposit insurance fund. So some relief there, John. But the reasons for today's rally could be as simple as this sell-off had gotten really dramatic. Even with today's rally, let's focus on PacWest. It's down more than 50% this week alone, so we could be watching some knife catching going on.
It was a double-digit stock to start the week. Brutal stuff over the last couple of days. Katie, wonderful, thank you. Let's turn back to the earnings. Two names, Lyft, Carvana. Lyft plunging after delivering a disappointing sales forecast. Carvana, on the other hand, expected to turn a profit following a strong Q1. Abby has more. Hey, Abby.
Hey, John. Yeah, truly a tale of two different car stocks here and stories, fundamentals happening here. Now, starting off with the shares of Lyft, they are plunging, the worst day since February. And as you said, the quarter that was not so bad, but the quarter that is, the profit, they took the sales guide below what it was expected to be. Carvana, on the other hand, the used car sales company that has had some going concern risks in recent months, well, it's soaring on the company, saying that it will return to a profit in this current quarter. Now, if we return to Lyft, what's going on here, it seems that the demand for ride sharing is pretty strong, but the per rider economics diminishing. So their second quarter revenue range slightly light, the EBITDA range a little bit light there. They're basically sacrificing the near term to gain share from Uber in the longer term. Relative to Carvana, the used car market is stabilizing. The first quarter was strong. So they do see this profit coming this quarter. They're seeking to cut debt. The amazing thing about this stock, John, over the last 2 years, it has gone from anywhere between a $3.72 stock to a $372 stock. Not surprisingly, there's a massive short interest, a 50% short interest, sending that stock higher today. Let's see where it lands as this year trades on.
Their biggest problem right now for Lyft, they're not Uber. Lyft right now is negative 19%. Abby, thank you. Let's get back to Apple. Analysts across the board highlighting their solid results amid a challenging backdrop. Wedbush's Dan Ives calling them LeBron-like results in a shaky macro. He goes on to write, quote, the iPhone beat was front and center and is clearly an indication that where gains in China are continuing despite a murky macro, Apple remains our top tech pick. Dan Ives joins us right now. Now, Dan, I know you're constructive, so work with me. This is from your own note. Total revenues down year over year. Let's go through piece by piece. iPad revenues down year over year. Mac down year over year. China down year over year. Dan, is this a growth stock anymore?
Yeah, but look, you got to think about the 500 bip headwind from FX, which is important when you look at what real call constant currency growth is. Look, China increased 500-600 bips sequentially. And I think into the next few quarters, you're going to see growth and go into next year, double-digit growth. I think it's about that install base. I mean, they're further monetizing it. They're gaining share in China. And ultimately, from a street perspective, it was a Goldilocks quarter.
Let's talk about the buyback plan as well. Another $90 billion, raising their dividend for an 11th year in a row. Can you frame down how powerful that is? I had one analyst say to me and the team yesterday that if you don't want the stock, Apple's going to buy it anyway. Is that how powerful that buyback plan is?
It is. Look, and I think right now it's a safety blanket stock in what's a shaky macro. And you're seeing that across big tech. And for Apple here, this is just a further flexing of the muscles from the buyback dividend to what's happening in China. And you really start to think about the narrative here with services now starting to show an uptick on the App Store. If you think about the reasons not to own it, I get valuation as some continue to sort of view a glass half empty. Some of the parts, we think this is a stock that goes north of $200.
Services came in a little bit lighter than expected, Dan. The way you painted the picture just then was a constructive way. Why is that?
Yeah, I view it as it's an inline services where the whole focus is can this start to go back toward double-digit growth into the next 2 to 3 quarters. And if you look at the tea leaves with Cook and Cupertino, how they're laying everything out, I think we'll see more at the developer conference in June. I think this will be back to double digits in the next 3 to 4 quarters. And just given the macro, it's sort of a shining light in a dark storm. And that's why I think more and more investors that were underweight Apple and they continue to yell fire in a crowded theater, they're just going to have to be forced to owning this because of what's ahead on the product cycle.
Dan, I was speaking to Pierre Ferro of New Street Research. He's kind of middle of the road on this name. And there's huge conversations about how to value the stock, what multiple to put on it. Pierre and I had that conversation this morning. Is it a growth name anymore? You suggest it is. Is it a luxury player? LVMH-type margins without the price resistance to some of the iPhones. What is it, a staple? Dan, how do you value this company?
Well, first off, in margins, Keane talks about this a lot. If you look now with owning more and more of the chips in the supply chain, I mean, margins are actually increasing, even in a negative growth when you factor currency in. And I think this is all about the install base, 25% of the install base. has not upgraded their phone in 4 years. And I think that's ultimately going to lead back to growth, back to double-digit growth. And China, it ultimately is increased not just sequentially, but into next year. So in the macro, it's obviously better than anyone out there and from a tech perspective. But I think it's about what it looks like into the next 4, 6, 7 quarters. Betting against Cupertino, I mean, it's like betting, against Steph Curry, in my opinion.
Well, Steph Curry or LeBron, you've got to pick someone, Dan.
Look, LeBron obviously is the GOAT, but in this series, I think Steph, could be carrying it.
Dan Ives, thank you, buddy. Still constructive on this name. That name is up now by almost 5% in early trading, about 10 minutes into the session. Looking at the broader market, we're up by more than 1 percentage point on the S&P 500. On the NASDAQ, up by a similar amount, and a big bounce back in some of these banking names. Let's get Western Alliance up on the screen. PacWest on my screen has been halted, up by more than 40%. Western Alliance is flying as well. Western Alliance, they're up by 59%. Big moves for some of those names. Big moves. Up 33% on Western Alliance right now. Let's get to iCapital's Anastasia Amoroso. Mike Collins at PGIM joins us now. Anastasia, how hard is it to be constructive on this market, given everything that's been happening over the last couple of weeks?
Well, I think it's gotten a little bit harder, John. And the reason I say that, we had a nice recovery in the second half of April. And at the same time, there's two risks. They're really unresolved right now. And the first one is the banking turmoil. And I appreciate that some of these bank names are up today. But you know what? There's no fundamental reasons for why they're up. And as you talked about earlier in the program, there's no circuit breakers yet in place to end this banking turmoil. So that's one issue that I think markets have to grapple with. And then the other issue, which people are probably not talking enough about, is the debt ceiling. But as you know, the debt ceiling needs to get resolved by sometime in June, and the time to do it is May. So I worry that the policymakers may drag their feet on resolving both of those, mini crises. And for that reason, I'm a little bit less constructive, perhaps near term, as I was coming into April.
That's a change for you, Anastasia. How are you expressing that change over the last month?
Yeah, it is a change. And, coming into April, the view was that it's definitely we're poised for an optimistic shift and you want to be long stocks. And, I think as stocks have sort of recovered and maybe some of the tech names have rallied quite a bit, maybe you do pare back some of those gains. Maybe you write some call options on them, especially because volatility has spiked once again. But I do want to make an exception, John, that, I do think the tech resilience may actually continue. And so any sort of weakness that we get in tech in particular, I would be a buyer of. But trimming, whether it's a rebound in financials or trimming some of the cyclicals or trimming some of the small caps, I mean, to the extent they have any recovery, I would very much focus on getting out of the kind of economically interest rate sensitive names and getting into more defensive tech.
Mike Collins, what do I do with this treasury market? And great to catch up with you, buddy. It always is. Mike, do I buy it because of ultimately lower growth and financial stress? Do I sell it because the data looks decent?
I love to come on here and pound the table with a lot of conviction, Jonathan, but with the 2-year bouncing around 4 and the 10-year bouncing around 3.5, I mean, it's really hard to pound the table on interest rates. I mean, right now, what's being priced in, if you really step back and look at the big picture, the tail risks, as we talked about, are really fat. There's probably about a third probability of a really strong economy, like GDP growth around 2%. With higher inflation, there's a 1/3 probability that growth just kind of stalls towards 0. And then, of course, there's this big downside, nasty 1/3 probability tail of something much worse, a deeper recession. So if you have the good scenario, rates probably go up 100 basis points. If you have the bad scenario, they probably go down 100 basis points. And here you are kind of stuck in no man's land in the middle. So what we're doing is really looking for backups in yields here to add duration. We are not long at these levels. And I think that's the right thing. I mean, with the funds rate at 5.25 and the 10-year at 3.5, I mean, that is really inverted. And that 10-year ultimately could get dragged back up if the Fed is able to hold its ground, which is very possible. So you wait for rates to back up a little more, then you add duration. And the same with credit spreads.
Mike, can you think of anything that works in both scenarios?
Yeah, I mean, bonds, right? I mean, this is actually, if rates back up or stay where they are, Jonathan, you're earning these really big yields in high quality fixed income. It might be a once in a generation type of opportunity. So that's the good news. In the downside scenario, this is a very different world than last year, right? If you have that deep recession, and presumably in that world, inflation does come down, the Fed doesn't cut rates 100 basis points, they cut rates 300 basis points, and bonds kill it, right? So I think it's a carry story, in the upside, and it's a capital gain story in the downside. So this is definitely an opportunity over the long term to have more fixed income in your portfolio.
Mike Collins, Anastasia Amoroso, sticking with us. We'll have a conversation about the latest from the president. He says, my plan to invest in America is working following a robust payrolls report. The U.S. payrolls report coming in hot.
The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
The reaction from Washington up next.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Expedia CEO Peter Kern. That conversation at 1:30 p.m. Eastern, 6:30 p.m. in London. This is Bloomberg.
What they're hoping for is this immaculate disinflation where you just slowly weaken the labor market. Unemployment rate only goes up to about 4.5%. The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
President Biden likes what he sees. This is what he tweets, quote, that's 12.7 million jobs since I took office, an unemployment rate that is the lowest since 1969 and the highest share of working-age people in the workforce since 2008. My plan to invest in America is working. AMH joins us now in Washington for more. Morning, Anne-Marie.
Good morning, John. Well, this is an interesting one for the president because, of course, this is the first jobs report we have since he announced he's running for 2024, and he's making his pitch once again for the American people. He's talking about the fact we have this low unemployment rate since May of 1969, and, of course, this massive beat on the payrolls front. Of course, the president's not going to get into the nuance that you and I are going to do, which is, of course, the revisions of 149,000 jobs to the downside. But this is a strong report for them to tout some of these really incredible numbers in the jobs report. Of course, Jonathan, we have to remember 18 months away. That is when we have the next election, and the Republicans are going to try to use the economy, most notably inflation, against this president. But expect more from him later today. He's gathering with his cabinet to talk about investing in America, and ahead of those comments about investing in America, what his cabinet and he is doing, he's going to talk about this jobs report.
Lots of nice things to say about the jobs market. I'd like to hear a whole lot more about what's happening with the financial system. Anne-Marie, thank you. Down in Washington, for a final word, Anastasia Amoroso, Mike Collins back with us. Anastasia, is there a good reason right now to buy regional banks?
No, Jonathan, I don't think so. I mean, I think for regional banks, it's a bit of a vicious cycle right now, which is the shares are under pressure and investors and depositors lose confidence, and then deposit outflows can still very much be on the table. And if that's the case, then that potentially can lead to more short interest if that's possible in some of those regional banks. I mean, that's kind of the market cycle vicious scenario. But the other side of it is you've got funding costs that are still rising, have to rise for these regional banks. And at the same time, lending is becoming incredibly constrained and the demand is falling, the supply of lending is falling. So that's just not a good outcome for net interest margins and for net interest income. So I think it's still a very much challenged area until you either have the Fed that starts to cut rates or you have the FDIC insurance that actually does cover all the uninsured deposits. Until that, I just don't see a big opportunity in equities and bank equities.
21 minutes into the session, PacWest up by 48%, Western Alliance up by 34%. That's a bounce back, Mike Collins. That's the equity picture. Anastasia went through it there. The profits, they're going to be challenged, Mike. On the debt side, what does the picture look like?
Yeah, it's not a great earnings story, Jonathan. So as a debt holder, you don't really have to worry about earnings growth too much. We are not involved in the regional banks, thankfully. The big money center banks are benefiting, right? They are growing. A lot of people say, why don't the big ones buy the small ones? And obviously you've seen a little bit of that with JP Morgan, but they're already acquiring their business, right? They're acquiring their loan growth, they're acquiring their deposits. The capital ratios of the big banks are awesome. They are really, really good debt investments. We own a lot. We've been adding to them on weakness here. It's a really good opportunity for fixed income investors.
Where are you taking credit risk more broadly at the moment, Mike? Where are you more comfortable doing so?
Yeah, it's really interesting. I mean, you're not getting paid again, not to sound like a broken record for going down in quality here. That 1/3 downside tail I was talking about earlier is not priced into the markets, right? That kind of slow, soft landing is what's priced in here. I mean, credit spreads could be wider, probably will be wider in 6 and 12 months as those tightening lending standards that Anastasia mentioned really come to the forefront. So you stay in the banks, you stay in agency mortgage-backed securities, which have gotten killed. You stay in, AAA asset backs, and you buy all these high-quality bonds. Maybe you're, a handful of your favorite high-quality, high-yield bonds, which are still attractive given their default fundamentals, and you build a portfolio that's out yielding, treasuries or your benchmark by 200 basis points. I mean, that's what the markets are giving you right now, and it's a really good long-term opportunity.
Just another wild week. I think we're all itching to get to the weekend. I'll let you both go. Anastasia Amoroso, Mike Collins, to the two of you, thank you very much. About 22 minutes into this session, the broader market, better than okay. It's a bounce back. We're on a 4-day losing streak on the S&P. We snapped that on the S&P 500, up by more than 1%. Let's get you some sector price action. Here's Abby.
And your idea on a wild week is certainly shown here sector-wise, John, because on the day we have most sectors higher. In fact, energy up by 3%. Many of the sectors, most sectors up by more than 1%. But if we take a look at the week that was, not so much. All 11 S&P 500 sectors lower. Big losses. These are the worst. Energy the best today, but worse on the week, down about 6%. Then you have the communication services down. That was some of those mega cap techs. Financials, not surprisingly, down. And then the materials down, too. So much volatility, John.
Abby, thank you. Your trading diary up next. Attempting, trying to take a chunk out of a weeky loss on the S&P 500. About 26 minutes in, we are positive by a little more than 1%. On the S&P, on the Nasdaq, up by a similar amount. And those two names, PacWest, Western Alliance, bouncing back as well. Let's see if it stays that way. That's the price action. Here's the trading diary into the weekend and beyond. Fed speak picks back up this afternoon. Bullard and Cook, 1 p.m. Eastern Time, Monday. The highly anticipated Senior Loan Officer Opinion Survey, followed by President Biden's debt limit meeting with congressional leaders on Tuesday. US CPI on Wednesday, PPI and another round of claims on Thursday to get you towards next weekend. Let's get to this weekend. Enjoy your weekend if you can. From New York, this was the countdown to the open. This is Bloomberg.